Okay, so welcome to the Expat Tax Thailand webinar on tax planning before moving to Thailand to explain the Thai income tax rules, how they've changed, and some key points and strategies to consider before moving to Thailand. So I'm Carl Turner. I'm the co-founder of Expat Tax. And the purpose of this webinar is to provide you up-to-date information. And here at Expat Tax Thailand, we're here to help individuals understand the Thai tax filing obligations, understand the rules so they can make better informed decisions before they move. So we're here to help. If you do have any questions, feel free to put them in the Q&A box. And if you're watching the recording, feel free to get in touch by email or through the website. So who will benefit from watching this webinar? So there's two specific types of people. One is anyone who's not a Thai tax resident, but may potentially be in the future. So people who are planning to move to Thailand. And also anyone who is a Thai tax resident that may be in the future, they may not be, and they can plan accordingly. So the areas that we'll go through today, we'll go through some case studies for certain situations. We'll go through some examples of the types of planning that people can do and the types of visas that are maybe a bit more suitable for people. We'll go through and talk through the tax rules in Thailand, explain what assessable income is and isn't. We'll actually discuss the double taxation agreements as well, because it's very important for people moving to Thailand. We'll go through the Thai tax allowances deductions, what common reporting standards are, how enforceable it is, and then we'll get onto the Q&A session. So feel free to put your questions in the Q&A box. We'll answer them at the end. If we don't manage to get round to them by the sheer volume, we'll reply to you individually. Just to let you know, this is being recorded, so we'll send out the recording by email over the next week or so. So just a quick disclaimer before we start: the content provided, it's intended for information purposes only, doesn't constitute professional tax advice, and should not be acted upon just from watching the video. So let's go through the key announcements and dates. So there's three specific dates that are really important with this. So 15th of September, this is when there was an announcement from the Revenue Department, which was a departmental order issued to overrule the previous rulings. So the rules in Thailand changed at the start of this tax year. It was actually published in the Royal Gazette, and it came into effect on the 1st of January 2024. This affects anyone who remits foreign source income, overseas income like pensions, investments, rental income, and salary. And it has a significant impact for anyone who's living in Thailand who brings in foreign source income. So anything from employment salary, property rental income, property sales, and Thailand's a remittance tax basis. So it's very important to note its assets. If you are a Thai tax resident, it's assets that are remitted into Thailand. So there's another announcement in November, which actually showed that cash in the bank from previous tax years is not assessable income. That's very important. And the new order actually has started already. It started on the 1st of January 2024. And any offshore source income remitted to Thailand by a Thai tax resident, so that means someone who's in Thailand 180 days or more in a calendar year, and they remit assets into Thailand that is deemed as assessable income, is taxable in the year that it's remitted. So there was an official document last month in July from the Thai Revenue Department just to explain how foreigners living in Thailand can pay tax. There was no hidden surprises, and the information on here was consistent with what we've been advising clients. And it's clear that the Thai Revenue Department, they're taking this serious, and they produced a lot of content and information now. So it's pretty clear how this will work. And foreigners really need to include income sources within Thailand and outside Thailand on their personal income tax return. So who will this affect? So as mentioned, anyone who is a Thai tax resident, so 180 days or more in a calendar year. Most visa holders, so it doesn't really matter what you come in on, whether you've got a retirement visa, if you have a permanent residence or business visa, marriage visa, the new DTV visa, doesn't really matter. It applies to all of these. The only real exclusion is the long-term residency visa. The only downside, there are some higher qualification requirements for retirees and business to qualify. We do actually have a specific webinar on this. So what is the LTR visa and how can this potentially help, especially if you've not moved to Thailand yet? Well, it's for high net worth expats living or moving to Thailand. It's a royal decree, meaning that it's exempt from the new rule changes for foreign sourced income. So personal income tax, there's an exemption on foreign sourced remittances if they bring in the money in the following tax year. So that's quite useful for a lot of people. We do actually have a webinar on this with a lot more detail. If you would like more information on this visa, feel free to get in touch and we'll be able to provide you with more information on this because this might be a suitable fix for some people. So let's go back on to what is taxable in Thailand under the Revenue Code. So there's 8 different categories under Section 40 of the Revenue Code. What I'll do is just explain where the key assets that people tend to have are. So Section 2 is actually pensions. So pensions are assessable income. Investments and property sale is under Section 4, so that's where that comes in. Property rental income is Section 5, and any other activity not specified earlier is Section 8, so things like trusts. So now we know what is taxable, what isn't taxable. So any asset or income that isn't transferred or spent into Thailand, remember, it's a remittance tax basis. So it's not global taxation or worldwide, it's just on remittance, so transfer into Thailand or spending in Thailand. So yeah, so it's a remittance basis. So previous tax years when they weren't a Thai tax resident is not taxable. It's not assessable income. If you bring in income from previous tax years when you were a non-Thai tax resident, that's really important for people who are moving to Thailand. And the rules that were announced in November, it cleared up the remittance of any cash in the bank as of the 31st of December 2023. That can be brought into Thailand anytime in the future. So remittance of original capital. So if you have investments or properties that haven't made a profit, you can bring in those assets and they're not classed as assessable income or taxable. Inheritance, that's not taxable in Thailand if there's inheritance from overseas. Gifts, so it's potential to gift assets to individuals. It's quite complex and this isn't really good for tax planning, but it follows gift tax rules. And we have a lot of information on this on our website. And loans are not taxable. And transfers to Thailand from non-Thai tax residents, very important. So when we're looking at moving to Thailand, what is not taxable? What's really important for yourselves? So any asset or income that isn't transferred into Thailand or spent in Thailand, it's pretty clear that's not assessable income. Remittance of any cash in the bank from pre-2024. And also more important for people looking to move to Thailand, remittance of income, so cash in the bank from previous tax years when they weren't a Thai tax resident. So let's say this year you don't stay in Thailand more than 180 days, then that means next year you can bring in any cash that was in the bank as of the 1st of January 2025. So it's really important with this, how we actually classify this. So it really makes a difference for people that are looking to move to Thailand to plan. And also transfers to Thailand from non-Thai tax residents. So if you transfer as a non-Thai tax resident, that's not assessable income in Thailand, unless the work was conducted in Thailand, of course. So we know this is complicated. It's confusing for a lot of people that are not in the tax world. And to be honest, it's not really necessary for people to fully understand or calculate their own situation. That's why we've got a job and to handle the assessment and the filing process. And we have a frequently asked questions section on our website. We've got hundreds of questions that we've answered. So you might be able to find some of the common questions answered on there. So we're here to help. So who actually has to file? So if you're over 180 days in Thailand and you remit foreign source income, so pension income, investment gains, property rental income, property sale gains, dividends, these types of assets, and you bring in more than 120,000 Thai baht as a married joint couple, or 60,000 as an individual per year, then you have to file a Thai tax return. This is regardless if you've paid tax on these assets in another jurisdiction. If you've got assessable income over the above, then you have to file a tax return. It doesn't mean that you have tax to pay, but because you might be able to claim for tax credits, for example, with the double taxation agreements, but it means you have to file. If you're remitting non-taxable assets like cash in the bank from previous tax years, inheritance, things like this, you don't have to add this to the Thai tax return. You don't have to file if this is your only source. Isn't it required for the visa renewals or visa application that you have a tax ID number or file a return. So if you meet the criteria to file, you need to get a tax ID number. You can obtain that from the local revenue office when you arrive, or we have a paid service at Expat Tax Thailand to obtain this on your behalf. We have to file the following first week in April for the following year. So for the current year, we'd file in April 2025, for example. And we have a service where it's fully online. We can actually file for people remotely from wherever they are in Thailand to take the hassle away from this. It's fully online application. We can guarantee all the allowances and deductions. So let's get on to a little bit about double taxation agreements. It's very important for people moving to Thailand to take this into account. So let's give a bit of a brief explanation. We do have dedicated webinars for various double taxation agreements that might be worthwhile listening to. So what is the purpose of a DTA? It's really to divide the right for taxation between contracting countries. It allows taxpayers equal rights depending where they live in. It sets the clear rules for who is able to tax certain assets. And actually a double taxation agreement takes precedence over local domestic tax rules. So there are 61 double taxation agreements, and we've researched them all. They're all on our website, and we've actually produced DTA specific webinars from the UK, US, Australia, Switzerland. We've got more to follow. So feel free to watch those in more detail. So the common misconceptions with double taxation agreement that is, if there is a DTA in place, it means that individuals are protected from tax in Thailand. That's not the case. Also, people tend to feel that if there's a DTA, double taxation agreement in place, and they're taxed in one country, it means that they're exempt from tax in Thailand. That's not the case as well. It depends what the double taxation agreement says. And a lot of people say if there's a double taxation agreement in place, it means they don't have to file or report because the tax is paid in another country. That's not the case either. So let's go through this in a bit more detail. The DTA may allow tax credits against the Thai personal income tax. You may be entitled to a credit for the tax paid in another jurisdiction. And it allows you for, if you've been taxed for the remittance that you bring in, you might be able to claim some of that tax back. You'll need a tax certificate from the other jurisdiction and use the credit to submit with the tax return. So you can use your Thai personal allowances with this. It doesn't mean you don't pay tax. It just means that we can potentially use as a credit for some of the tax paid in another jurisdiction. We can look at the gross and net amount. It's very important how we run the calculations on there, and then it's assessed on a case-by-case basis. So how are the assets taxed, and what does the DTA say about specific assets? So we get a lot of questions from people moving to Thailand about different assets. So what I've done is just quickly go through some of the common double taxation agreement questions. So I've looked at US Social Security, So US Social Security for a Thai tax resident is not assessable income. It doesn't need to be filed on a Thai tax return. It's excluded with the double taxation agreement. Let's look at UK state pension. If that's remitted to Thailand and you're a Thai tax resident, this is assessable income. You can use any tax paid in the UK. It's a credit. US 401k, a bit more complicated. You have to file a tax return in Thailand and pay the tax on that, but you can potentially claim back the tax in the US. Australian superannuations, if these are remitted into Thailand as a Thai tax resident, then it is assessable income and it's taxable in Thailand. There's no exclusion on this with the double taxation agreement, even though in Australia it is tax-free or tax efficient. That's not the case if it's remitted into Thailand. Property rental income. Now, this all depends on the country of the property. Usually, the double taxation agreements show that both countries can tax. So it means that the country where the property is situated can tax on the property rental income. And then if it's remitted to Thailand, it can potentially be taxed in Thailand as well using a tax credit. But you've got to check the double taxation agreement specifically because this does vary. It's just a rough guide. Property sale, again, really depends on the country and the double taxation agreement. But quite often it means if you sell a property in another jurisdiction and remit the money to Thailand as a Thai tax resident, you can potentially be taxed on the gains. It's really important to check that. And investment capital gains, really important for people moving to Thailand. It depends on the double taxation agreement, but the likelihood is most countries' capital gains on investments, if they are remitted into Thailand, are classed as assessable income in Thailand. And that's not on just the time that you've been in Thailand, but it's on the gains on the structure since you've had the structure. So this is important to discuss later on. So then we thought we could go through some of the typical tax favorable investments and pensions which are not tax-free in Thailand. So this is where there's some planning pre-move that might be worthwhile considering or discussing. So let's look at some of the common ones. So Roth IRA pension distributions, they are tax efficient in US, but in Thailand they're not. It's assessable income. UK pension commencement lump sum, so the 25% tax-free lump sum that you can get from pensions, and UK ISAs, both are tax efficient and tax-free in the UK, but they're not in Thailand if they're remitted as a Thai tax resident. Australian superannuation, so we mentioned that before. This is one of the tax favorable pensions, which if they are remitted into Thailand is assessable income. And residential property sale. So really important, depending on where you're from or where your property is located, whether this is a residential property or not. If it's a residential property, a lot of countries don't tax you on the gains if you have been living there. If you become a Thai tax resident, sell the asset and remit into Thailand, you can be liable for the gains depending on the double taxation agreement. So these are really some of the key assets that really need to be assessed before people move and can make a big difference if you plan with these. Another one which is really important to touch on and explain the rules in Thailand is general investment accounts, so GIAs, so whether that's stockbroking accounts or similar accounts, investment accounts. How it actually works is you're taxed, if you're a Thai tax resident, you're taxed on the capital gains that are remitted into Thailand or percentage of capital gains on the overall structure since you've held the investment. So anything remitted to Thailand, you need to calculate the capital gains as a percentage of the amount you brought in from the overall structure. And it's treated as assessable income in Thailand. So this is not, maybe you need to check the double taxation agreement for the jurisdiction, but in general terms, this is how it works. So the capital gains is treated as assessable income. So the gains that are remitted to Thailand are added to income in Thailand. It's really important to assess any investments that you have before you move to Thailand because there might be some advantages to look at restructuring this potentially. You need to calculate for every transfer into Thailand. So if you make multiple transfers, you work out the gains at each point. So let's go through some of the common allowances in Thailand. So you can actually, once we've understood the DTA, what's taxable, what's not, it's important to see what allowances do you get in Thailand before you're taxed. So we'll just touch on this briefly. So everyone gets a personal allowance, 60,000 Thai baht. There's a spouse allowance as well if they don't have an income. Child allowances, health insurance up to 25,000 Thai baht for a Thai local medical insurance. And anyone over 65 gets an extra 190,000 allowance. So once you've got your assessable income and then you deduct all your allowances and deductions, then we look on the tax bracket. So the first 150,000 Thai baht is tax exempt. And then the next is 5%, the next 150,000. So it's a progressive tax scale. Over 5 million Thai baht remitted is 35% on any money over that amount. So what are the tax planning opportunities before moving to Thailand? So potentially restructuring of existing assets, because it's quite clear and evident with certain types of assets. If you do that or transfer when you are a Thai tax resident, there can be quite large tax implications. Also, what are the planning opportunities? Remitting any cash in the bank from previous tax years when you were not a Thai tax resident, that's available to yourself to bring in. Any asset that isn't transferred into Thailand, so it's only a remittance tax basis. So it's important to calculate how much do you think you will be spending in Thailand? What income do you need? Because it might be the fact that you don't need to restructure some or all of your assets because you've got enough in non-taxable income or non-assessable income that you don't need to do this. So it's really important to do the assessment, and it really is a case by case depending on your situation. So what I thought I would do is go through a few tax case studies with planning examples to really simply just explain, with tax favorable pensions, how that is affected if you are a Thai tax resident, investment gains and residential property. So exactly what I mentioned earlier, just to try and make it a bit clearer and understandable. So let's go through pension case study first. So let's talk through previously tax favorable pensions. So with this example, there's a 65-year-old, they've just moved to Thailand, or they're about to move to Thailand. They've got a US Roth IRA, Australian superannuation, and UK PCLS, so tax-free lump sum. So this person's traveled around and worked overseas in different countries. They're moving to Thailand. They want to buy a house in Chiang Mai for 10 million Thai baht. So they decide to take lump sums from each of the pensions equally. So we can see how it's taxed for each of the types of pensions because we take the same amount from each. So they take out 3.4 million from each of the types of pensions that they have. So the example is if they are a non-Thai tax resident when they do this, or if they are a Thai tax resident when they actually take out these assets. So if they are a non-Thai tax resident, so less than 180 days, then in Thailand in that year, there is no tax implication for disinvesting the funds from Roth IRA, the Australian super, or the pension commencement lump sum in the UK. And also, if those transactions took place in a non-Thai tax year, it actually means that they can remit that money into Thailand anytime in the future without any tax implications. Now, this doesn't mean there might not be tax implications in the jurisdiction that they live in. I'm just talking about for the Thai side. So if they were a Thai tax resident when they disinvest these assets and move to Thailand, so let's say they moved at the start of this tax year and they are a Thai tax resident for this year, and then they decide to disinvest some of their Roth IRA, their super in Australia, and their UK tax-free lump sum. Then if they did that as a Thai tax resident and moved the money remitted into Thailand, all of these pensions are classed as assessable income. So using the Thai tax allowances and deductions for a 65-year-old, it's 350,000 Thai baht that they're allowed as allowances and deductions. The tax on 10.4 million Thai baht bringing into Thailand would be about 3 million Thai baht. So nearly $100,000 of tax. So this is the tax calculator just to show how that's calculated. So it really makes a difference if you're a non-Thai tax resident or you are when you disinvest and make these changes. So the key point is planning in the year or years leading up to a move to Thailand could be quite beneficial for pensions. And I really recommend that you seek advice before moving or planning to use your pensions as income or disinvesting a large lump sum. There could be some advantages to restructuring before moving, but as always, it's not a simple calculation, and it could have implications in other jurisdictions if you've not moved to Thailand yet. So there's a lot of moving parts to this. And also, it might not be right for every situation, because if you decide to disinvest a large amount from a superannuation, for example, before moving to Thailand, well, what if you change your mind and you decide to move back to Australia or wherever else, and you've taken assets out of a tax efficient structure and you move back to that country, and it's not possible for certain types of assets to do by a certain age anyway, before a certain age. So it's really important that you seek advice and weigh up the pros and cons of making any sort of structural changes to this. It's quite a complex discussion. So if you would like a free tax assessment to really calculate and estimate what the tax could be, taking into account your allowances, deductions, we've developed a free tax calculator service. So you can get an estimate for how the new tax changes might affect you. If you do move to Thailand, how the income that you'd like to draw down on, how this would look in reality in terms of taxation. It's quite confusing to calculate, and we're here to help. So if you'd like to arrange a 15-minute tax calculator call, we can help you get an estimate so that you can, for your potential tax, so that you can make a better informed decisions on the tax positions and your own personal situation. So my colleague Jason is available for video calls through Google Meet to help people understand their own tax situation. So we'll send this out by email, or if you're watching on YouTube, there's a link in the description. Feel free to arrange those meetings for 15 minutes to go through that. We're happy to help so people can understand where they are now and what the potential tax is. So let's go through the next example, which is investment capital gains. So same person, 65-year-old, they've got a US general investment account. They've got an international offshore bond. They've got a UK ISA. So with these, the same situation, they move into Thailand, they want to buy a house with the money. So they decide to bring in partial withdrawals from the investments and take the same amount from each. So the same situation. So how would this, what would be the implication if they were a Thai tax resident or they weren't a Thai tax resident when they decide to take partial withdrawals from investments with capital gains? So if they are a non-Thai tax resident, 180 days or, 179 days or less, there's no Thai tax. So the capital gains tax implications in Thailand, there aren't any if they're a non-Thai tax resident, but there might be there will be capital gains tax implications potentially in the jurisdiction that you're currently living. So it's really important to do the assessment, but that means that you can remit that money into Thailand anytime in the future, not necessarily in a non-Thai tax year, as long as the partial surrender was done in a year that you were a non-Thai tax resident. So there's a lot of work to do in terms of calculating the tax implications in your own jurisdiction or where the assets are based. But in principle, that's the answer. And then also, if you are a Thai tax resident, how does this actually impact? So if you're a Thai tax resident, you're taxed on the capital gains on the investments for each account, not just since you moved to Thailand, but actually for the whole time that the investment's been running. And it's the percentage, what you're taxed on is the capital gain percentage that's remitted into Thailand of the overall structure. We can use the Thai allowances and deductions, and then we go straight into the tax table. So the capital gains tax in Thailand is actually just added to your assessable income. There's no specific tax rate for capital gains. It's assessable income. So in Thailand, the capital gains adds on to the personal income tax tables. So you really need to do the comparison. Is it worthwhile looking at disinvested assets before you move or after, or does it not make a difference? This is really where cash flow modeling really makes sense, and spend a bit of time on this. So you can plan a year or years leading up to Thailand. Could be quite beneficial depending on your circumstances. I really recommend that you seek advice before moving or planning a large withdrawal or partial withdrawal. There could be advantages to restructuring, but that could mean tax implications elsewhere. So it's really important to have a look into this. It's not a simple calculation exactly like with the pensions, but it could make a big difference if you do get that right. So next one, property sale. So I mentioned this earlier, residential property sales could potentially be taxable in Thailand. So same person, 65-year-old, he's got a residential property in Australia. He's moving to Thailand and wants to sell that to buy a house. So he wants to bring a large lump sum into Thailand. So he decides to sell his property in Australia. Doesn't really matter the location. With most double taxation agreements, it's the same. So he sells the property for 1.2 million Aussie dollar, so 28 million Thai baht, and he transfers that into Thailand. Bought the property for $300,000 20 years ago, so there's a large capital gain, 900,000 Australian dollar capital gain. So let's have a look at the examples again. If he's a non-Thai tax resident, so sells the property, if he is under 180 days, then there's no tax implication in Thailand if the money's remitted into Thailand that year or any subsequent years, because the sale took place in a non-Thai tax year. For this example, if it's an Australian main residence, he's not taxable on the capital gains. Now, how does that look if he is actually moved to Thailand already? So if they've already moved to Thailand and they're a Thai tax resident, and then they sell the property, and then they remit that money into Thailand, then under the double taxation agreement, then actually they could be liable for the tax on the gains on the property. So it's a big difference. So all we can do is look at the allowances, deductions, look at the tax tables, and that means actually out of the money that's remitted into Thailand, the tax on the money that's brought in could be up at 6 million Thai baht on the 30-something% of the amount once we've done the calculation. So just to drill home, residential property sale or assessing whether it's worthwhile selling a property, timing's really critical and crucial. There could be advantages to sell in the year before becoming a Thai tax resident. But again, it's complicated. It depends on the jurisdiction you're living in. There could be implications in other jurisdictions, but it's important to plan. So as you can see, it's quite complicated and complex. We do offer tax consultations, 1-hour consultations to actually go through this in more detail. So 10,000 Thai baht to have an online discussion to actually plan and discuss your own situation. Also, what we do offer, which is quite useful for a lot of people have been taking advantage of this, is we have one-on-one cash flow analysis consultations. So really to assess and plan strategy for what you can actually do and where you are now, what the tax implications are in Thailand if you bring in assets how you currently want, and then maybe do some strategy to see how we can potentially reduce that in the future. So this is just an example of one of the cases that we went through. Someone came to us with an example of the income that they wanted to draw down on. They were retired and they want to draw down on their assets. This was what we modeled before taking into account tax. So this is time, and these are their asset values. Once we took into account the Thai income tax, we noticed that they would actually run out of money in their 80s because of the Thai tax implications of how they were going to remit them in. Then after doing a bit of tax planning and future income pre-move changes, we got then to the point where the funds would last well into their 90s. So that's what we can do. We can actually model quite simply where people are now, taking into account Thai tax, and then look at what they can actually do pre-move, or maybe a different type of visa might help to help the cash flow ongoing. So if you'd like to discuss this, then feel free to get in touch. So on to Thai revenue. So common reporting standards. How will the Thai revenue know? So it's really important. Thailand's actually signed up to common reporting standards. And they actually signed up in 2020. And the first exchange of information was September last year, 2023. So the common reporting standard countries, it's over 120 now that have signed up. So there's a free flow of information, and it's a global initiative to stop people avoiding tax liabilities. So what kind of assets are under the scope and what's reported? If you're a Thai tax resident, then anything like bank accounts, credit cards, pensions, investment platforms. If the jurisdiction where your assets are part of common reporting standards, then this information is passed to their local revenue office, and then that is sent actually to a Thai revenue office if you're a Thai tax resident. So what's reported? Name, address, tax ID, ins and outs, account value, and that's reported every year. It's actually reported by an XLS file, so it's sent electronically to the revenue departments, and then they share that with the revenue departments where someone is living. ATM and credit card usage is shared, and we'll discuss this later on. What's the implications of not declaring in Thailand? Okay, it's pretty harsh. Up to 200% assessable income is a penalty for the amount that's owed. Surcharge of 1.5% per month for every month that it's owed on top. And also it can affect visa status in the future, and also imprisonment and a fine. So it's pretty harsh. So a bit of tips for and advice. I think it's really important to plan your move in advance. You can calculate your potential income tax for the different asset classes. We can help you do that. We can potentially restructure in the years or year before becoming a Thai tax resident. That's quite important. You've got a big advantage over people that are already a Thai tax resident. You could consider the LTR visa, because this has certain tax advantages for foreign source income. It's really important that you keep good records of remittance, so transfers into Thailand, and track every transfer. And really, it's good practice to separate out the different sources of income into different bank accounts, so it's easy to report when you are a Thai tax resident. Remember, we are here to help. We're happy to explain the rules and help people really understand where they are now and what they can do to understand how much the tax will be. So some of the services that we offer, get the free tax calculator video call. Feel free to arrange those. One-on-one tax planning strategy consultations. It's been quite useful for people that are considering moving, so they can really nail down exactly what this means for them. And like I mentioned earlier, the detailed cash flow analysis and income projections, that's available as well. Tax filing services, helping people obtain tax ID numbers. If you have any questions, feel free to get in touch. We've got a comprehensive tax filing guide to help you understand the rules with easy steps to follow, and it's free to download on our website. If you would like to book in the free call with my colleague to go through your own situation and the tax calculator, then please do. And if you'd like to sign up to the tax alerts for any changes or upcoming changes to the Thai tax rules, we'll keep you updated on there by email. So we'll keep you updated with our newsletters with any changes to the rules that come up. So let's get on to the Q&A session. So if I plan to send my money into Thailand in a year when I spend only 180 days in the country, then move there permanently after that, do you agree, Carl, is sound strategy? Well, yeah, so the limit is actually 179 days that you need to remain in Thailand, not 180. If you say 180, then you are a Thai tax resident. Let's go through some more questions. Yep, so I plan to send money. I plan to send money into Thailand. Okay, yeah. Is super taxable in Thailand? Yes. So superannuation pensions are taxable in Thailand. If they are remitted into Thailand as a Thai tax resident, yes. Is it possible to reset tax residency if I fill my Thai tax form for January 2025 for tax year 2024 and live below 180 days in Thailand in 2025? So I'm no longer a Thai tax resident, for then to move back to Thailand later in 2025 or in 2026. So I'm again a tax resident in Thailand and do tax filing for 2027. Yeah, I don't really understand the question. I think it means, can you become a non-Thai tax resident for a year? And then in that year, disinvest or move assets around them, remit into Thailand in the future? Yes, potentially. But the problem with looking at this sort of planning is you may pick up a residency that's worse than what you're trying to achieve. So some nationalities, if you don't have a tax residency, so if you do just decide, right, I'm going to remain out of Thailand for 108, stay under the 180 days, and you move around the region, for some nationalities, that means that you reset to your domicility, so you can actually reset back to the country, which might be worse implications than what you want to achieve. So, for example, Australia has this rule, so it's really important that you plan that accordingly. Is it only cash in the bank per 31st of December 23, or that are tax free? What about stock portfolio value as of the 31st, 2023? So a good question. This depends if you're a Thai tax resident or not. If you are a Thai tax resident, then assets, cash in the bank, as the value as of the 31st of December 2023 can be brought in any time in the future. For stock portfolios, this rule doesn't apply this 31st of December. It's actually the capital gains on the assets since you've held the assets, and whatever you brought in, it's what percentage of that is capital gains. If I transfer savings to Thailand and not current income, I'm still working, something I've been saving for a while, would it be taxable? If not, what proof, paperwork would I need to submit? So let's assume that they are a Thai tax resident and they're bringing in savings in the bank from previous tax years, then that's not assessable income. Let's go through some more. Do I lose one? Okay. Do we lose the personal allowance in the UK? I don't have to pay any tax in the UK because I'm under 12,500 allowance. Would this be ignored in Thailand? So yeah, very good question. You don't lose the allowances overseas anywhere else. But if you remit into Thailand, then you get Thai personal allowances and deductions. So you might not have paid tax in the UK or another jurisdiction because it might be under the minimum, but potentially if you remit into Thailand, depending on what other assets you've got, you might be taxed in Thailand, but you do get Thai allowances and deductions on there. You don't count the overseas allowances and deductions. Let's look at a few more questions. So to confirm, if I stay in Thailand 179 days per calendar year, regardless of the visa, I am not liable for any taxes or even to file a tax return. So good question. It depends. So A good answer. So it depends what kind of assets you have in Thailand. So if you have property rental income, you have salary in Thailand, for example, then these are assessable income regardless if you're here for 180 days or not. So it depends what kind of other assets you have. But in principle, if you're under 180 days, you're not liable for taxes on foreign source income that's remitted into Thailand, as long as that work wasn't conducted in Thailand. Let's look at a few more questions. Yep, so let's have a look on here. If someone uses Revolut or UK savings account, credit or debit card while staying over 180 days, are these spendings taxable? So a very good question. We've actually met with the revenue to discuss this at length. And how it actually works with debit cards, credit cards, this is, if you're a Thai tax resident, this is assessable income. So it depends, it can be assessable income. So what we have to look at is, regardless of what's on a Revolut account or Wise account, what we look at is where's the source of the money on there that's being spent in Thailand. So if the money that's on a Wise account, for example, that's being spent in Thailand is from cash in the bank from previous tax years, then it's not assessable income. But if the money that's being spent is from, say, a pension or large capital gains that have been added to a bank and then using the ATM card, that's assessable income. And the problem with this, you've got to always look at, even if it's not in the tax code, you've just got to look, is this within the spirit of the tax rules? That's really important. And if you're using foreign credit card and then paying it off with assessable income, then 100% if you're audited, this will be classed as assessable income, and it should be as well. Yeah, so question about pensions. So what if your pension crystallized cure-ups is currently in a country with no DTA, Malta? Is it better to move funds to UK accounts? So a very good question about if you have assets in a jurisdiction that doesn't have a double taxation agreement with Thailand, what does this mean? All it means is you can't use any tax credits. So if you paid tax in that jurisdiction, you can't use that tax credits and claim that back. But it doesn't really matter if the assets are, if you've got a pension in, this example was Malta, or you've got a pension in the UK, if you remit in that pension, it's still assessable income. The difference is if you've paid tax in the UK on part of that, then you could use the double taxation agreement to use the tax you've paid as a credit. But if you're in a jurisdiction where there's no double taxation agreement, but the tax was favourable, that doesn't really matter. You pay the tax in Thailand rather than in that country. So again, if you'd like to have a discussion about this complicated DTAs, it's important to get more content about this. Yeah, it's really important. I paid large sums into a Thai hospital by credit card. These sums have been substantially refunded by a UK health insurer to my UK account. Is this considered a loan by me? Yeah, this is quite complicated. So credit cards is an area where it's not in the revenue code. So what does that mean? It means, can you prove beyond reasonable doubt that this money that you've spent on the card is not assessable income? If you're using the credit card and paying it off with, what is it being paid off with? Is it assessable income or not? It's not a route to use to not spend money in Thailand. It's really important that you look at it from the side of the tax revenue and what they're trying to achieve as well. So if you're looking at using a credit card to pay and avoid tax, then that's tax evasion. And that's where those pretty harsh penalties can come in if you were audited and they feel like you were evading tax. Some of the questions that came in earlier by email. So I'm considering moving to Thailand. I have to transfer 800,000 Thai baht to a Thai bank. Do I have to pay tax on that? So if you're a Thai tax, let's talk about Thai tax residents, because if you're a non-Thai tax resident, then it's really irrelevant. We know that that's not assessable income. If you're a Thai tax resident and you have to remit money, I guess this is for the visa, the retirement visa, 800,000 Thai baht. If you're remitting that into Thailand as a Thai tax resident, then again, what we care about is what's the source of the money that's being used to bring into Thailand. We don't care what it's for, whether it's for hospital bills, buying a new car, paying for a school, or for this requirement. All we care is what's the source of the money that's being remitted to Thailand, and we don't care where it's paid to either. If you've transferred assets into Thailand, regardless of where it goes to, then we need to assess, is that assessable income? Next question, if I pay the rent and other living expenses with a card, either from Australia or Switzerland, is that taxable? Okay, so same question as earlier. If you pay with an overseas card, where's the source of the money that's on that card? So is it assessable income or not? It's really important that you keep clear records if you are using overseas cards to pay for things. Next question, if I remit UK monies to a builder in Thailand, would this be assessable income for me and or the builder? Okay, let's assume that the person is already in Thailand and they're a Thai tax resident. If you remit money into Thailand, so transfer from an overseas account into Thailand to a builder or for any other purpose to a school or anywhere else, then that is assessable income, and it's your assessable income, not the person you transfer into. So some more questions. If I remit savings to my Thai bank 30 months prior to becoming Thai tax resident, but after the 1st of January 2024, will this be tax assessable income? Right, okay, yeah, so this is really important. So if you're a non-Thai tax resident for 2024, then next year you can bring in any account balances up to the 1st of January 2025. So you can bring anything from the previous tax years if you're a non-Thai tax resident. So let's say you moved in 2026, then you can bring in anything up until the 1st of January 2026 in the bank, cash in the bank from previous tax years without any assessable income. I hope that's clear. Let's have a look at a few more questions. If I stay July to December in Thailand in 2024, so 179 days, plus January to June, another 179 days, am I not liable to file tax returns for either calendar year in Thailand at all? So this question's about, the amount of days, and does it have to be in the same order or consistently? So it's all to do with a calendar year. So if you're at the 1st of January to the 31st of December, that's the calendar year for tax residency. So how many days have you remained in that calendar year? Doesn't matter about the previous year or the year after. It's not like certain countries where it's 3 out of the last 5 years. It's very clear, it's year to year. So if you're 179 days in both years, then you're a non-Thai tax resident. Really, if you are looking at that sort of planning, like I mentioned, you've got to be really careful that you don't pick up another jurisdiction, which is worse than what it is in Thailand in terms of taxation for the assets that you are disinvesting or whatever you're doing. It's important to seek advice for that, in my opinion. Let's see if there's any more questions. I think we've got through them all. Yeah, so any else that we haven't gone through, I'll happily get back to you by email. If you do have any questions, feel free to get in touch. I think it's really important to plan your move in advance, to really calculate the potential income tax for different asset classes. There's the option to potentially restructure in the years or years before becoming a Thai tax resident, but it's really important to note it's not as simple as that. You've got to look at the other factors, whether it's the right decision or not. You can also consider the LTR visa for certain situations because there are certain tax advantages for this. It's important to keep good records of remittance and track every transfer into Thailand and separate out the different income sources overseas if possible. Remember, we're here to help. If you do have any questions, feel free to get in touch. Thanks for listening, and Yeah, and if you do have any questions, just go through the website. We have a Q&A section. There's a lot of answers on there as well. Okay, thank you. Bye-bye.